Okay, we have 45 more seconds before we start. Okay, let's get going. Hi guys, my name is Nitin and I serve as Director of Financial Sciences and Digital Assets at IBM Research.
Nitin, have you recorded a session yet?
Yes, I've turned it on. Wrong.
Oh, it's a recording. Thank you.
Okay, no worries. So let me start again. Hi, my name is Nitin and I serve as Director of Financial Sciences and Digital Assets at IBM Research. A super exciting topic today. I've been, looking forward to this event. I'm actually calling in from India. It's early in the morning, and I'm here primarily for vacation. But at the same time, I met a lot of industry leaders in this space in terms of what's happening in emerging economies. But before we get into the meat of the topic, I'd like to make a quick introduction of what this is all about. We have seen an interesting sort of evolution. Both what we have seen in the enterprise space, but what we've also seen in the emerging sort of ecosystem with emergence of new asset classes. We've seen convergence of social, technical, and economic constructs evolve. The recent emergence of non-fungible tokens, the recent sort of continuation of what cryptocurrencies and crypto assets and digital assets have kicked off in the past decade, have not only represented a whole slew of opportunities, but it also has led to a massive amount of opportunity landscape and challenges for our regular financial institution. And so what we intend to do today with this esteemed panelist, and we've had at least 4 or 5 calls behind the scenes in preparation for this event, is spend some time in talking about the future of finance. What are we talking about in terms of introduction of new tokenized assets? We will spend some time on the evolution of digitization to tokenization. We'll discuss what that means. And each of our panelists have sort of core competencies that we will lead this conversation with. I will tell you this, that the space that we are talking about today, especially in terms of emergence of new financial instruments, has reached up until yesterday about $2.3 trillion, which is still 1% of the overall global economy. But this emergence has sort of transpired in the last, I would say, 1 year or so. So it's a significant shift and change. And I think as technologists, as financial professionals, we are trying to understand the emergence and convergence of this sort of exciting space into the traditional finance, and what are the challenges both in terms of technology, which is applying data and AI, and building the new rails and new infrastructure to be able to move these new instruments. But at the same time, looking into some of the regulatory and compliance landscape, both in terms of opportunity, but also in terms of the formulation of RegTech and the data, the role the data plays in this new enforcement in this space. And towards the end, we will sort of, try to understand both from the IEEE agenda, but at the same time, looking into core tech in terms of looking into digital assets and market infrastructure. And Oshani and Augustine will spend some time in sharing their expertise. So without any further ado, I would like to spend some time in introducing our panel before we get into questions and leading with some of the elements. I'd like to first introduce Professor Chen. Professor Chen, really glad to have you on this panel. Could you take a few minutes to introduce yourself? And I believe you're calling in from China.
Yeah. Thank you, Nitin. Hi, everyone. I'm Chaochao Chen. I'm currently a staff algorithm engineer at Ant Group. My research area currently mainly include privacy-preserving machine learning and AI. From my perspective, I think AI plays more and more important roles in financial. especially when the traditional finance becomes internet finance with the development of internet in recent decades. So I think most of the traditional finance is taking place offline through many labor force, while internet finance can take place online and automatically using the techniques like big data, AI, and machine learning. Yeah, thank you.
Excellent, Professor Chen. Really glad to have you and glad you could make the time. Truly an international panel. So let's move on to Paul. Paul, really glad to have you again. And I believe you're in Singapore. Tell us a bit more about yourself and your perspectives on this topic.
Okay, sure. Yep. So yes, I'm Paul Griffin. I'm Associate Professor at the Singapore Management University in Singapore. First of all, well, what I'm currently researching is sort of the disruptive technology in fintech. I spent over 15 years working in some major banks in IT. Prior to that, I was actually in physics. A lot of physicists did move into banking in the sort of late 90s. I kind of joined that surge, but then decided to go back to university and do more research rather than sort of applied, and kind of take that to research and to education students as well, and teach them some of the lessons which I've learned over the years. So currently, yeah, blockchain, quantum computing, and the whole area of disruptive technologies have to come around, but also looking at, all disruption is not necessarily good or bad for all people. So how does that play out? How do regulations play into that as well? I work quite closely with the Monetary Authority of Singapore, and it's a regulator, and it's a very interesting, and there's no kind of black and white answers. So I'm looking forward to this discussion very much. Thanks.
Oh, that's great. And we work with MAS as well. I think it's one of the most sort of advanced, regulatory and compliance agency in the world in terms of what they do with central banking and so on and so forth. So really glad to have you here. And Paul, at some point, love to understand the shift from being a physicist to getting into finance. I get the quantum piece, but love to understand a bit more as we progress this, through this conversation. Moving on, let's speak to Oshani. Oshani, it was really a pleasure talking to you last time in preparation for this event. Please share your perspectives, and I believe we have a common acquaintance, and I really love the work that you all are doing at RPI. Tell us a bit more.
Sure. So I am Oshani Seneviratne. I am the director of health data research at RPI. So as you can guess from the title, my official title, I have very broad interests. I have done distributed systems, decentralized systems, and currently I'm doing knowledge representation on health data. I do have an interest in blockchain and DeFi, but that's a very, very recent interest. With respect to DeFi, I have recently been looking at characterizing the world of DeFi because it's growing at a very, very rapid pace. It's very hard to keep up with the space. So I've been, having this effort with our mutual acquaintance in characterizing this world of DeFi. And I've also done some work on smart contracts because I am a computer scientist by training. So I've been looking at, program analysis and, again, looking at how we can augment smart contracts, how we can even supplement decentralized applications with things like, account recovery when things go wrong. So those have been, some of my past interests in the world of blockchain. So actually you asked this question, what's our outlook for finances, or future outlook for finance is going to be. So I'm no finance expert. However, I can say this though. I did my PhD under Tim Berners-Lee at MIT. And as you may know, Tim Berners-Lee is the inventor of the World Wide Web. Now, yes. When he invented the World Wide Web in 1989, no one, really knew how this is going to scale. But now if you ask a question can you imagine a world without the web? I think I cannot. I certainly cannot. But if you ask the same question from somebody in 1989, the answer is going to be pretty different. So I think we are in that 30, if not 50-year growth phase in the world of finance, like, where everything will be digital in few years. I don't know, like, I can't predict the future. Maybe it's going to be 30 years, maybe it's 5 years, who knows? But I think it's going to happen eventually. And I think this is an exciting area to be in, an exciting, field for researchers like us. So that's really my, outlook. I really hope, this thing will be, successful.
No, I think that's brilliant. And I think what you're doing with Center of Advanced Finance, again, at Rensselaer Polytechnic Institute, and the recent work, I think what we have seen with the National Science Foundation, some really cutting edge work. And I couldn't agree with you more that, and I was in college, so I'm dating myself here, that we were trying to tell the industry about, the file transfer protocols and how will this change the business? And people were looking at you like, how will this change my business? And lo and behold, we were moving information, and we moved all the middlemen from the picture back in the day. So I think we see a similar movement with digital assets, which is the area that you're going to cover with us today. So looking forward to that rich conversation, especially with your expertise and your experience from the web, and you can draw analogies. So that's great, Oshani. Welcome to the session. Okay,
yeah, it's
last
an honor
but
to
not
be on the panel. Yeah,
of course. Last but not least, Agostino, my friend, me and him have been going back and forth a lot in terms of digital assets. He has been doing some cutting edge work at Columbia University, both in terms of application of non-fungible tokens. He's been working on non-fungible tokens before they were cool, I would say, is looking into, figuring out as to what is the application of real estate, and looking into, collateralization of real estate using these non-fungible tokens. So Agostino, tell us a bit more. And I believe both Oshani and Agostino are from New York. So this is truly a global session. Even though I live in Austin, I'm in India today, and we have Singapore, and we have China, and we have 2 New Yorkers. So tell us more about your perspective, Agostino, on this space and your experience.
Yeah, absolutely. So I've been interested traditionally in financial intermediation. So I come from a finance background, and I've been looking at how to mitigate all these sorts of counterparty risk when you have financial transactions. And I've recently, the last 2 or 3 years, shifted towards understanding intermediation and provision of liquidity in DeFi exchanges, where you can trade crypto tokens, and essentially looking at mostly from a mechanism design perspective. So how can you incentivize? I think back to what Nitin was saying before. How can you adopt a decentralized finance platform? Because meaning you remove the middleman from the picture, so everything becomes decentralized. But do people like me or you or Nitin, me, everybody can post liquidity, but meaning when would we do that? Meaning what are the pros and cons of the blockchain technology? Because as I will show also later during the talk, meaning when you use blockchain, you make very difficult to make profits for liquidity providers due to the fact that they have to compete in order to get executed. And then I'm looking at recently at better design of the blockchain system, both from the non-fungible token perspective and also from the information design of the platform. So essentially everything is public knowledge in blockchain, and this transparency question, the fact that there is a lot of transparency also has some cons, because malicious, not malicious, but profitable arbitrageurs, they can basically take advantage of the fact that they can see what transactions are being executed and front run, for example, orders. So I'm looking at flash bot protocols that you can relay on the top of the blockchain in order to essentially ensure privacy of the transactions, and see whether or not this might make decentralized intermediations more likely or more profitable for all the market participants. And I think this is basically where I really think that the brick and mortar finance is basically close to being dead, and there will be a big shift in decentralized intermediation and liquidity provision with exchanges, both centralized and decentralized exchanges.
Yeah, no, that's brilliant. And I think, to me, when you say that brick and mortar finance is dead, it's similar to what we were discussing a decade ago with brick and mortar retail. So I think between you and Oshani, when we get to the digital asset, I think it's and again the impact on existing financial system. So that's great. I think we have a great agenda. So for the audience here, we generally have 3 broad topics. The first topic we'll start before we go into disrupting the world, as Oshani and Agostino have painted a picture for us in this introduction, is looking into where we are. So financial industry, largely like any other industry, has been going through this journey of digitization. And the digitization, both in terms of what we have done with payment rails, what ISO 20022 is, digitizing finance in terms of digital securities, dematerialized assets. There's been a whole evolution of moving away from paper-based movement of assets to truly going after digitizing finance. And in the past decade or two, we have seen a massive growth in data leading to application of AI and focusing on the fact that this massive growth of data that's happening in the space, both in terms of transactional data, but also in terms of adjacent data that's coming from situational applications, that's coming from location application, that's looking into fraud analysis and so on and so forth. That's leading to newer business models. We begin to see digital-only banks. We begin to see, and I have a few favorites in the world who have completely lopsided the entire business model to say, we will do the banking, but we'll not do it the way it has been done for the past 100+ years. It also has an impact on data regulation. We've seen that with CCRA in California. We've seen that with GDPR and many of the leading sort of data jurisdictions in the world. Every country has a data regulation. It puts us at a crossroad that while the digitization implies evolution of data, but the regulation around the data has either an impeding effect and looking into how these business models can evolve and really be effective. And the last thing I would say is that the entry of big tech into financial services players, which is Google and Apple and Amazon's, getting into financial services are doing better because they have a contextual element of the consumers. In convergence of finance into a daily life, I think the millennials and the Gen Zs don't really want to go to a bank and do the things that we did, or I did at least, from dating myself here. But that has a massive impact. So maybe I'll give the lead to Professor Chen as a starting point. Professor Chen, I'd love to get your perspective in how do you see this unfolding with the new business models, the data regulations, and convergence of finance and big tech coming into the space?
Sure. Thank you. Let's first talk about the new business models in future finance. So I would like to share some thoughts on this. Currently, we are heading toward a digital age. Data becomes the digital format saved in many computers and clouds instead of on traditional handwritten papers. Therefore, many kinds of new business models come into force. Well, I'm going to share two cases. The first case is intelligent user credit assessment. And traditionally, the bank agents need to manually collect users' credit information, such as income, capital assets, and other personal properties, so that the bank can give a comprehensive profile of a user. After this, banks analyze these profiles using certain kinds of rules and finally give user a credit assessment. Well, this kind of way relies on heavy labor force and is usually quite time consuming. So nowadays in future finance or in current finance, with rich kinds of data becomes digital format, the bank or many internet financial companies can use AI and machine learning techniques to do user credit assessment intelligently. Well, this requires much less human input and also is much more efficient. Usually it could be done online. The other case is intelligent insurance. So take car accident, for example. Traditionally, when an accident appears, an insurance agent needs to go through the accident, gathers information about the accident, and takes a very long time, say days, to evaluate the accident and finally pays for the damage. Now, with AI techniques, when car accidents appear, it is possible that people can simply take a photo of the accident and the damaged car, upload it to server, and then the insurance company can use AI techniques to analyze how much would it pay. So this scenario relies on computer vision techniques, and this could be done automatically and efficiently. That's what I'm seeing the new business models. So as for the data regulation, yes, I can agree with you more, Nitin. So in my opinion, many new business models come with privacy concerns. On the one hand, regulations and users have their requirements of privacy protection. On the other hand, data across different devices or different institutions need to be combined together so as to build a better AI model. Therefore, privacy-preserving machine learning or privacy-preserving AI appears to solve this problem.
So one question I have on that while we are discussing this, which is I think a very pertinent question as you bring up, right? Privacy-preserving technologies and what we have looked into federated learning is keeping the sanctity of data and still applying some of the AI techniques to be able to provide analysis and keeping the biases in ethical AI aside. What do you think are the core, like for example, some of the work we were doing at fully homomorphic encryption at IBM and applying that to financial sciences, we looked at the computational framework and the cost of computing is oftentimes exorbitant. I just want to get your thoughts on the fact that when we look at privacy preservation, which in context of data regulation applies to say we do want to preserve, does the insight apply to the same level of regulation that suddenly now applying these? And yes, it may be computationally expensive, but the insights coming out of it, do we apply the same lens to it?
I think it relies on different kinds of situations and different kinds of resources. So currently, privacy enhanced computation usually involves techniques such as secure multi-party computation, homomorphic encryption, federated learning, or differential privacy. So different kinds of techniques have their own advantages and disadvantages. Therefore, we need to handle these techniques case by case. And the main purpose is to achieve a trade-off between security, efficiency, and utility. Yeah.
Got it. Thank you. Please continue.
Okay, I think that's pretty much of my opinion. I think other panelists can really share their
I'd love to hear, Paul, your perspective on this, since you're in, again, the jurisdiction that's dealing with this head on, both from inviting technical companies, technology companies, as well as the regulator who are forming this framework. Love to get your thoughts, Paul.
Okay, so yes, I mean, there's different sides and nothing's perfect. But first of all, I think I'd just like to go back to what the regulators are there for. I think people get to see them as either slapping fines on companies or to create problems for technologists in trying to do their job. But really, the bottom line is they're there to protect the economy. They're there to protect people. And I think with that kind of insight, and particularly for technologists, it's all around kind of the technology risk management. So MAS has this great document. I do recommend people to have a look at it, called the TRM, which was started a number of years back and has been recently updated. But it's all around how to manage your technology risks. And I think a lot of startups could also do with reading that and following at least the main guidelines. I'm still kind of shocked sometimes. But also from the regulator side, there's this idea of, hindering innovation compared to regulations, but I think they can also help to help innovation as well. I mean, for example, on the protection side, you've got the explainability of AI. Over the past few years, there's been a number of stories where AI systems had to be shut down either in trading or for lending because they couldn't explain why particular things were happening. And now there's a huge industry starting up in explainability for your AI models. So it's interesting to hear about the data side of that as well. because you need to be able to test those models out. But also I think the regulators could, in my opinion, do more to help as well, like the ICO debacle a few years back. I mean, that's a great idea, crowdfunding great projects through people, individuals. The ICO is the initial coin offering, like an IPO, but for the crypto world. And there were some great projects. Unfortunately, I think 70–80% were actually fraudulent. And if there had been regulations, if that had been able to be in a regulated marketplace, I think we'd still see a lot of ICOs now, where instead they've kind of pretty much gone away. We have been replaced by STOs and other kind of more stable coins, and which are becoming more regulated. So I think regulations can help and hinder. And also I think in terms of sandboxes, so in terms of the data side, there's a lot of good sandboxes run by governments around the world where people can pilot their applications. So you're kind of protecting the people in the economy by limiting what you can do, but still allowing innovation to progress and having small scale, real production pilot applications in sandboxes once you've gone through the paperwork, as it were. And I think that could certainly be improved. And there is actually a global collaboration happening now called GFIN, which is exactly setting up a global sandbox. So I think there's the governments looking to the future, as well as the startups and the technologists. I don't know if there's anything else more you want to say about.
I do. I think the sandboxes idea, which is, I think MAS in Singapore has done an amazing job with partnering with its cohorts in FCA and UK, for instance, in terms of creating those regulatory corridors to say, if you have a licensing in one jurisdiction, you're able to, and, able to do business in a different jurisdiction. And I've always felt that many of the regulatory and compliance framework have direct implication on technology design. And I've, having built a few payment systems and having built in, working financial industry, you realize that we go with, what the landscape has or what the regulatory policies are and how do we adhere to those to reduce cost of compliance. And technology plays a huge role, exactly what Professor Chen was talking about a few minutes back. And privacy preservation is what's the right, whether we use differential privacy or FHE or the secure multi-party computing. They all have different cost structures, but they all also have different sort of value propositions. So from that perspective, love to get your thoughts, Paul. You're in a very unique place, both as a person of science, but also understanding the space really well. You mentioned ICO and STO. What is the overall sort of opportunity of regulatory arbitrage in the space that you're dealing with two jurisdictions, one of which may have a much more stricter data privacy guidelines, implying the use of massive force of technology, while the other jurisdiction may not have the same sort of lens? What is the impact on technology? Because at that point, it's not unavailability of technology, it's use of technology in the right way. And second thing is, I'd love to get your thoughts in terms of, adjacent to that question is RegTech and data role on regulation enforcement, right? Is how does RegTech keep up with that arbitrage that's happening across the globe?
Okay, so first of all, I think just kind of continue with this point. I think technology startups have to, or should embrace regulations and not just see them as something to fight against or try and avoid, which leads into the question of regulation arbitrage. There's two main reasons for doing arbitrage. One is the competitive aspect. Is you want to go to a country which will allow you to set up your product or set up your technology in an easier fashion, maybe cheaper, faster, more efficient than another country, which makes you go through more hoops. The other one is actually trying to avoid some regulations. So if you're on the kind of like the evasion path, then at some point you'll probably be caught out, because governments are trying to harmonize the laws and also trying to build conflict frameworks as well. So there's a number of sort of initiatives to, in the place where countries don't harmonize, then how can we build a way to be able to resolve conflicts between different regulations, which works in favor for both countries. So evasion is not really the best route, whereas if you're going for competitive advantage, then kind of why not if you can do it. The whole landscape is very complicated and always changing. China, for example, goes through cycles of regulations. They'll they'll reduce regulations to encourage growth, and when it gets big enough, you can see them to bring in more regulations. That's happened in cryptocurrency a number of times over the years. Other countries, similar kind of cycles. In the US is very, very confused over cryptocurrency, and different states have different ways of dealing with it. And it's an interesting space to watch. I don't think there's any kind of one answer, and it just has to be kind of a case-by-case basis.
No, I think that's a great point. Or two, sorry, please go ahead.
I was going to move on to RegTech. So okay, yeah. So on the kind of so coming on to the question of RegTech, I mean, it's a huge industry. I mean, it kind of kicked off really after the global financial crisis in 2008. That's when people kind of woke up that we need to do something, more and a lot better. So it's really focusing on the regulatory processes for compliance teams. So I mean, the regulators are kind of setting the scene, and the RegTech come in and try to kind of ease. So it could be a vendor, it could be products. Last year it was $33 billion industry. It's looking to exceed 130 billion by 2025. So it's a big industry. It's always growing, getting more sophisticated. And of course, as more data comes along, you can do a lot more for we're going to have to do a lot more automation for regulatory reporting, auditing systems, fraud detection. So AI is very much a big part of that. So yeah, I mean, it's a big and improving, and I think it becomes more sophisticated, which also kind of leads to the kind of legal aspect as well. Is there is kind of often a discrepancy between the way a system behaves and the way the law behaves. I was doing some work with a faculty in the School of Law in SMU about trade finance, and what he described to me of the ways trade finance law is set up and the way blockchains in trade finance work. There's a huge discrepancy on both sides. The law doesn't really take into account blockchains, and blockchains don't really take into account all the intricacies of the law. So I think there's a lot of work can be done in that space, which would improve the technologies and profits of the companies and financing for the companies as well.
Yeah, so that's a great point. And I'm just trying to understand this, Paul, that if you look at some of the international bodies, the FATF, and BIS as Bureau of International Settlement, and likes, and they have set forth both in terms of the regulation around travel rule. Lately, BIS in conjunction with, for example, have announced Project Dunbar, and with MAS is facilitating cross-border payments, removing the friction and the cost that goes with it, which really is a burden on the least sort of favored in the society in terms of the fact that they're disadvantaged and the remittances space. And so there's a lot of initiatives, both from global bodies as well as some of the local regulatory agencies like MAS and like BIS. I'd love to get your thoughts in terms of the fact that we have talked about blockchain and DLT and the constructs that emanate from these things like stablecoin and central bank digital currencies. What is the impact on existing financial system and existing RegTech, in the sense that the existing financial system, and maybe this is after your perspective, we'll move on to the SMEs in that space, which is Oshani and Augustino, is I'm always working in this space, and I have spent some time in this space, is that the existing system is sort of a batched relay system, which is connected through complicated financial system, and that is leading to the friction and the cost that every bank, every financial institution has their own batch processes before they move the assets, and that batch relay is costing, opacity, and opacity leads to fraud and leads to cost and so on and so forth. Suddenly, you're going after with DLT and blockchain, bringing this to bearing and introducing transparency, which I think is rather drastic in terms of a technology approach, and we've seen positives and negatives that you have a slew of things. Especially the existing financial system that had spent trillions of dollars in building treasury management, cash management systems. How do you see them coexist? That while these new projects like Ubin and Dunbar have tried to understand the ramifications of digital assets and tokenized assets in the system, how do you see them coexist, especially in context of RegTech, reconciling the two together, if that makes sense?
Yeah. That's always a big question in any IT anywhere. Is you've got your legacy systems, you've got something new and fantastic, and who, when, how do you move between the old stuff and the new stuff? And I think the payments and Swift and all those systems which have been going around for decades, they're well tested. They have a lot of volumes going through. But I mean, for me, my personal view is blockchain DLTs have so many potential advantages that it's a journey towards them, which I think we will cover over the next probably 10, 20 years rather than 2 or 3 years. I mean, because they do offer, you don't need to do all the reconciliation. I've worked with teams of people whose only job is to reconcile data. That's their life, and that can be certainly reduced by using blockchains. Probably not completely eradicated, but certainly reduced. Speed, efficiency, fraud. I mean, Swift messages are text messages. You can open them up, change some text, and push them back in the system. So there's lots of areas which the old technology, which has done a very good job, can be improved on. So I think it's really some way a kind of a case by case as well. I don't think we're necessarily going to see a huge change until there's a big problem. Often catastrophes can actually spur on digital transformation. So we are seeing the effect of COVID now to increase a huge sort of step up in the use of digital technology, because you have to. So that's one kind of drive. And I think over the years we'll get drivers. There'll be big fraud events, there'll be systems, old systems not working. So there's always going to be a push towards something better. And as DLT blockchain continues to, I mean, there's a lot more use cases. I'm talking to companies now with 2 or 3 years of using a big blockchain in production, millions of transactions going through. And so as those become more visible and seen and resilient to problems, then I think there'll be a greater uptake. So it's a journey. RegTech side of it, that will also kind of come along as well as more regulations need to be done. Like a couple of years ago where I was working, we had to move from end of day position reporting for investments to intraday. That was a huge change, and it becomes much more real time. So more data, more real time. We're going to need better systems to be able to do that type of reporting, which the customers and regulators are demanding. And I think, as was mentioned earlier, the size of data is growing, the speed of data is growing. And I think that's where quantum computing will become another technology. Some years still to get that mature enough to be in production, but see that as another point on the horizon beyond blockchain, where we will see that we need to use new technologies to be able to cope with the data sizes and keep everybody safe and businesses efficient.
Yeah, no, that's brilliant. And I think we could spend a whole hour on quantum and the whole level of data. But I can see Oshani sort of eager to jump in, because we've talked about digital assets, and don't hold yourself back, Oshani. Go for it.
I was gonna, touch up on one thing that Paul mentioned. So you asked this question about, regulation, regulatory differences between different countries. And I wanted, chime in a little bit, because, one of my colleagues at RPI, she recently did a paper on crypto colonialism. And I think that's a direct result of, these differences in regulation. So one interesting use case that she had was all these, crypto bros who are in the United States, they go to, somewhat less developed countries, even a place like Puerto Rico, US territory, and they, push, certain, crypto projects on the local community. And I know it's not within the scope of this panel, but I was, curious to, kind of raise this question of some, social issues, of these differences in regulation. And same thing I've seen, I'm Sri Lankan, so I've seen these advertisements on the media. They are on this Oxfam giving some donations in cryptocurrency, for certain flood victims or whatever. So then the victims are forced to kind of they have to use cryptocurrency. So I just want to bring up that point. That's a weird, or I don't know, an unfortunate side effect of these differences in regulation. And I don't know if Paul, you have something to say about this. So feel free to ignore my comment, but yeah, I just wanted to pick it up.
So before Paul jumps into that one, let me first later, you bring up a really good point. And if you look at a bunch of data, which I've been looking at in preparation for this event, the top 10 countries who have adopted the digital assets, and I always use the word crypto assets as opposed to cryptocurrencies, only because it's a whole slew of things that go into it. And you'll find that countries like Philippines and India and now Afghanistan and US is like number 6 in that entire, and Vietnam. Some of these countries are much bigger in terms of percentage of per capita. And while they may not have the volume and the value sort of numbers behind them, you begin to see the movement on. So I basically wanted to bring up the question of the broader industry impact of digital assets, cryptocurrencies, stablecoins, CBDC, and at the end of the day, whatever vernacular that's emerging in this space boils down to tokenized movement of value. And if you're looking at the impact of these instruments, both in payment infrastructure, which is what I think Paul was alluding to say, hey, you have all these international agencies trying to move money out of more transparency and reduce the corruption and reduce friction and reduce cost across the world. What is the impact of these tokenized things of value, tokenized assets on the existing technology infrastructure that we have been building, all of us, and have been aiding in building that for the past, I would say, 4 or 5 decades. And the impact of capital markets. I mean, if you can tokenize money, you can tokenize real estate, you can tokenize capital, securities. And I think Paul did mention the ICO, STO capital formation boom, which is introduction of tokenized sort of value. And so just want to get your thoughts is what is the broader industry impact on the technology infrastructure, which is one of the areas of what IEEE focuses on, is what do we focus on here? Yes, there's impact, there's transparency, and there is all these goodness that's in the system. But what do we need to consider both in terms of that new infrastructure that we're building, which can coexist with the existing one?
Is that to me? I could.
Yes. So Oshani, we're moving to the third area.
Oh, I see. Okay.
You
Yeah.
and Agostino in terms of digital asset and market infrastructure. So
Yeah.
it's a free flow of thoughts. Just let me get your thoughts and then have to get.
So I can do a thought dump on
Go for it.
On the infrastructure side of things. So as I mentioned, I was heavily involved in web technologies for a very long time. And as you probably know, there's a standards body called World Wide Web Consortium. Now, the original web, there were these HTML, HTTP protocols, and then people started building interesting websites, which I'm seeing a parallel in the DeFi space. So we have the protocol, which is Ethereum, and then, the Solidity programming language, and people, build all sorts of, cool things, and, people can compose things together because they're all on the same, infrastructure. One thing I really like about this infrastructure we are seeing in the DeFi space is that it's like, show me the code, talk is cheap, right? Like, people actually build things. Whereas, one thing I have mixed feelings about standardization and, those kind of, you mentioned about IEEE, I'm not really sure what kind of, standards body you were thinking there, but in terms of if you're thinking of some broad standards body, I kind of feel like it's good to discuss what makes sense in different sectors, but I think almost always the winner is somebody who makes this very innovative project or product, and then people start using it rapidly, and then there's a lot of innovation that's happening out of that one critical piece of software. So I kind of have that attitude towards all these broad scale adoption kind of things. I think it has to be organic. I think we can talk all what we want, and then the process that W3C had was there are these working groups, they meet every week, and lots of telecons, lots of talk, and then at the end we have a bunch of specs, and then there are reference implementations. But in my opinion, I think these implementations have to come first, and I think that's something that the DeFi world is doing very well. The products are there, they're composable, they can build interesting things. And if you're an entrepreneur who's getting started in this space, unlike in the traditional, entrepreneurial, like, Silicon Valley, going to get, funding from angel investors, like, that takes a lot of effort. But like, here you can actually start something and then like, release it and see how it gets picked up. And there are lots of success stories like that in the DeFi space. So that aspect I really like. And I think the industry, I don't know, I don't know if that's gonna work for all possible, products out there, but I think almost all the successful ones have, started out with one great idea and then people adopting that in the industry and beyond.
No, that's brilliant. And when I referenced IEEE and all the standard bodies around the world, I'm looking at from engineering. I mean, this is all think tank, in terms of everybody who's here has an engineering interest, and standards play a really critical role from global adoption and sort of conveying certain elements of specifications that everybody can follow and expected results around it. So while the innovation has to continue, as what I think what you're referring to, it's important at some point we standardize this so people, exactly how, the World Wide Web proliferated back in the day, that we had all these raw tech floating around, but eventually when standards emerged, the global adoption became really, really rampant and rapid. And I think whether you're looking at it in terms of traditional standard bodies or looking at from an engineering effort, at some point things have to be engineered, things have to be built. Yes. And that's the perspective that I wanted to bring. But no, I think I share that perspective as well, that you break fast, break often. So you come to what you've learned and move forward with that. I'd love to get Agostino's perspective on this as well, because Agostino, I think, as you described in your point of view, that you have, while DeFi was cool, it is so 2019 or 2020 that now you have NFTs. Love to get your thoughts in terms of what Oshani's perspective has been.
Yeah, I mean, I don't want to interrupt the flow. I have some slides that maybe I can show, or you prefer me to talk?
It's your call. It's all free flow. So share whatever you can.
Let me share, because it's really addressing some of the issues that have come out. Let me do that. Yeah. So I want to, I think you asked like the perspective on my perspective on DeFi, right? And I think I agree that there are a lot of opportunities for the industry to jump into the DeFi world. And I think one part that I like about DeFi is that it's very democratic, in the sense that it allows for financial inclusion, meaning it's not only like major players that can contribute and provide liquidity. They don't have to be financial institutions. They could be like private companies, right? As long as they have enough, they buy tokens, then they want to share those tokens on the platform, they're able to do that. And my view of the DeFi ecosystem is basically like the following: like you can use like DeFi for lending, so you can get funding, like for example, to create small projects, or you can get funding to create large projects. And this funding is typically get at the rates, which depends, you don't have to charge anymore very large interest rates, because I'm not worried that if I learn to Nitin, it can default, because I will basically be able to collateralize the transaction, and it will never default. And actually I cannot even prevent like default from being a concern, because I don't know who I'm facing, right? Everything is running on blockchain and there is a lot of anonymity here. And then the other big portion is basically liquidity. Like as I mentioned before, one important point of decentralized finance, basically being able to exchange, to swap tokens. Like if we want to exchange, let's say, a token on a cryptocurrency, for example, for Bitcoin, for Ethereum, or you want to change like crypto, like a stable coin for a more volatile crypto coins, you are able to do that basically. And you see that there are $24.44 billion locked in this decentralized exchange space. So it's really huge, right? It's like a market is evolving and is growing more and more. I think lending and this next, and then you can buy insurance like through DeFi, like again using blockchain. You can create financial derivatives. So it's basically replacing the full ecosystem. So now I want to also make a big point about like all these tokens that all the decentralized exchange that we are seeing. Meaning we started with Uniswap, and now we have seen that there is a lot of competition. There are a lot of companies that are essentially being built right now and providing the platform for trading these tokens, right? And I mean, the tokens are really like all. I mean, you can trade all kinds of tokens. You can trade like Bitcoin, stable coins. You can trade NFT, right? Non-fungible tokens. You can really exchange or swap token for others based on like what you have available and what you need, right? If I have to run my applications on Ethereum, then I really need to buy Ethereum token, right? I mean, because these have values for me, and therefore I can swap Bitcoin for Ethereum. So what I mean, I just want to look at a little bit at the market microstructure here, and like what happens is really, and this is why this is very democratic and very inclusive. Like if you want to be a liquidity provider, if you want to basically contribute to deposit tokens, like you have to basically follow the rule that is determined by the reserves that are in the pool. If there are 100 Ethereum and 10 Bitcoin, if you want to deposit and put more Ethereum and Bitcoin, you have to do it in the ratio of 10 to 1. So that's the so-called automatic market makers, right? They work in this way. You can basically add tokens, and when you add those tokens in the pool, then you get a share, which basically is your fraction of, I mean, how much you are entitled to get if you want to exit and you don't want to provide liquidity anymore. And the way all this works is basically that you are incentivized to be, you have to incentivize liquidity providers because they charge fees. So every investor that decides to join the pool will have, or to trade, to swap tokens in the pool, will have to pay a fee in order to participate. For example, if Nitin goes and sees that there are 100 Bitcoin and 10 Ethereum, and he says, okay, I really need Ethereum because I have to run blockchain. I have to run like a DeFi application on blockchain. So what do? You have to swap, you have to give me, or you have to give to the pool 10 Bitcoin in order to get 1 Ethereum because the ratio is 10 to 1. But you can do that. So everybody can go and swap tokens and get the tokens that he needs, right? That's why I think it's very important to have this pool full of liquidity, full of tokens, because then it's possible to swap and execute transactions. And I mean, these liquidity pools are really very, very significant, very economically very large. So you see that there are a lot of million USD dollars that are locked into this pool, and the providers are earning a lot of fees. They're earning $730,000. I mean, this is based on the last time I checked, which was August 18. So I mean, we studied. I mean, of course, I don't want to discuss what I did, but I mean, it's not self-advertising. But I want to mention that essentially a big question that arises in this liquidity is the question is basically whether or not there can be some liquidity free. So all of a sudden, nobody's providing liquidity, so nobody can really exchange token. If I have to get Ethereum for blockchain for Bitcoin, maybe I'm not able to do that because there is nothing in the pool. And unfortunately, this happens all the time. Because of the way blockchain works. So the idea is that if like there is a news about Bitcoin, right? And suppose that the Bitcoin token is devaluating. So then every investor wants to basically swap Bitcoin for Ethereum because Bitcoin is being devaluated, right? The question is that if people do that, then liquidity providers will be at a loss because they will basically not be able to prohibit those arbitrageurs from exploiting the opportunity. So you have deposited, let's say, in the ratio of 10 Bitcoin to 1 Ethereum. Now, because everybody wants to get rid of Bitcoin, all of a sudden, Bitcoin becomes much less valuable. So when you exit the pool, you have much less. And you would like to stop this order, right? You would like to exit the pool before somebody can exploit this opportunity. And the question is that, unfortunately, this is not possible because of the design of blockchain. If I want, for example, to stop an order from being executed, and I ask, let's say, I submit an order through the blockchain and say, cancel this order, I have to attach some fee, right? Because blockchain works in a way that you can only get executed if you have submitted a gas fee which is sufficiently large. But the idea is that suppose that I'm the arbitrageurs and Nitin is the liquidity provider, my gain is his loss. So if there are like a lot of liquidity providers, then the entire loss of these liquidity providers will be essentially only be borne by, will be completely absorbed by this arbitrageur. So every liquidity provider will only be willing to basically submit a fee which is lower than what the arbitrageur would do, which means that he will never basically be able to avoid this arbitrage opportunity. So there are a lot of it's not regulatory arbitrage, but it's really arbitrage due to trading. So there are a lot of opportunities for arbitrage that liquidity providers cannot really stop, because they cannot exit. They cannot say, okay, now I want to leave the token from the pool. I want to get the tokens from the pool, because you need to be selected for execution by the blockchain. So that's really a major problem. So I think really this is like for blockchain as an infrastructure is really suffering from this problem of privacy, right? I think this is also a point that was mentioned in the first intervention, not in the context of blockchain. But the idea is that basically every transaction that is being that is being executed and added to the main pool, which is where all these transactions are before the miners take them and put it in the block, they are visible to everybody, right? So everybody can copy an order. If there is a trading order which is profitable, maybe I can see and I can copy it. So how do you prevent this from happening? The only way is basically to redefine the information structure of blockchain. You want essentially to protect information. You want to make sure that there is no financial loss for the users. Yeah. And avoid that. The other point is that all these arbitrage orders, all these possibilities for making money, they are really congesting the blockchain network, because they are putting a lot of orders. So a lot of space is being taken exactly by the execution of these orders. And in addition, like, they are raising the fees a lot. So if you are using blockchain for other purposes, for example, for supply chain finance or for supporting non-financial transactions, these users will be at a disadvantage, because if they're using the same blockchain, they will have to pay extremely high fees because of this competition that is being created by these financial mechanisms. And one thing that we're actually looking right now is like adding what happens if you have Flashbot? What happens if you add this layer of privacy on top of the blockchain network? So then it means that nobody can see my order, right? In the sense that I submit this order and then there is an auction, and the first, like the one
you'd like to pause there for 1 minute, Augustine. I did have a question. I'd love to get Oshani's perspective on this too. Oshani, I think you have spent a lot of time on smart contracts and debating the role of smart contracts. And I think what Agostino is talking about here is nothing but a combination of all these smart contracts and DAOs who are doing these amazing things and newer business models and newer functions, whether it's automated market making or whether it's liquidity pools or whether it's locking the assets. Before, Agostino, you move on to the next, some of these things, love to get your thoughts as positives, negatives, where is this ball heading?
Yeah, I think this is excellent work. And yeah, I really like your, previous slide where you had that if exchange rates are, volatile, then the liquidity providers, they lose their money. I think it signals some, systemic risk in the, market, in AMMs. And I think, yeah, this is excellent work. And in terms of, like you had, one of the takeaways was like, redesign of the blockchain. I think like, that would be too disruptive. I guess like, that would be, however, I feel like, this could be done with like, better redesign of, smart contracts that cover these decentralized applications. So that's kind of my high level, like, very abstract, thought by just seeing this slide, just now. But, I also wanted to, mention, like, we also did something similar. Actually, it's an ongoing project where we looked at data from the Aave, borrows and, borrows and repays. And then we try to characterize, different behaviors of users. So, we've seen like, some users who lose their money, like, and they're trying to see like, even though the interest rates are volatile, like, it's only, some users that get liquidated, and, it's an interesting behavior. And some users, like, they make a lot of money, some users, like, don't do like too many transactions. So we're trying to understand, like, can we characterize these, user behaviors? So that's another thing, I could add on to what you're proposing here. But yeah, this is excellent work. That's all I can say. I don't know if Nitin, that answers your question.
I think it does. And I think, Agostino, I think what you're talking about is truly some of the thesis of what we all have been talking about, right? Is how is this changing the world? How is this changing the financial system? And at this point in time, this is all code-driven, something which is happening on a blockchain network. Very few people involved, except with the exception of developers. And to Paul's perspective, code is the law in this case, which it's a pun intended element, which is what the Ethereum founder had mentioned. But the regulatory landscape around this becomes enormously complicated. And I actually have an open question for the panel based on what,
Can I add something?
Yeah, please go ahead.
So you asked us to talk about stable coins. I think stable coins are at the heart of many of these DeFi protocols. I have this kind of problem with stable coins in a way, because stable coins exist because these cryptocurrencies are highly volatile, right? So the price fluctuates. So I wonder when these cryptocurrencies are very pervasive, will there be a place for stable coins? And then how would these liquidity providers work? That's, I don't know, I'm no finance expert, so this is really a question for the finance experts on the panel. I think
I can. It's a very good question, Oshani. I can provide a partial answer. So what happens is that the stable coins seems to be really, at the moment, the only coins that as a liquidity provider would feel comfortable depositing, because they are not really subject to a lot of fluctuations. So any coin which is like Bitcoin, maybe Ethereum, and any other even more volatile coin of any of the altcoins would be very dangerous at the moment, because as soon as this exchange rates between the crypto currencies change, then there are immense opportunities, a lot of significant and material opportunities for arbitrage. So any liquidity provider will really be hitting big losses. And this is actually something that you can see also from the day. If you look at trading that is happening on the centralized exchange, you can see how much arbitrage loss is being exploited. In fact, there are a lot of the specialists used to be those who were trading on limit order books. Now they are specializing on cross-currency arbitrage, right? They are trying to arbitrage away, from one currency to another, or even across different exchanges. So that's really, that's really worrisome, in the sense that you need to, it would be a pity if you can only adopt this decentralized exchange for stable coins, right? You want to have a larger set, but then if you want to do that, you really need to rethink the way that the trading is occurring in the first place. So how do you make sure that there are that liquidity providers are not vulnerable to those losses?
So you think stable coins will stay, right?
Yeah, at the moment they are the only ones that I would anyone. If I have to provide liquidity in an AMM, I would use stable coins, because I would feel less exploitable.
Yeah.
I'd also like to jump in as well. Yeah, I think just the other side of stable coins is a programmability of tokenization. So there's the stability, but also if you want to involve these particular asset classes. So if you want to buy gold, you can go and buy gold, or much better would be to buy as much gold or as little gold, like stock. There's been a lot of questions around, what if the underlying asset for stable coin is a stock, why don't you just buy the stock? But some stocks come in values of $10,000 for one stock. If you wanted to buy a tiny part of, especially a Japanese company, they have very kind of huge minimum quantities. But if you want to buy part of that and then build a derivative or build some automated system based on that particular asset class, then it gives you access to those assets and many more. So for me, it's a great, stable coins are a great another side to the crypto world. Just wanted to add that in. Yeah.
So
actually, I have another. Sorry.
Go ahead.
One last thing. So, that's another aspect that has been bothering me a little bit about stable coins. You have this asset-backed stable coins, and that introduces some centralized notion, right? A company has to hold X millions of dollars, or some reserve of gold. And then you mentioned about algorithmic, programmable, stable coins, and that also has some problems, because I think Basis got into trouble
Yes.
because of this
They did,
algorithm
yes.
like supply and chain.
Yeah.
So how do we balance? Like now, like is crypto backed stablecoin the only way forward, or
So I spent almost 4.5 years researching stablecoins, only because I had to build that into product. There are foundationally three things. I think you touched upon that, Oshani. Is one is basically collateral backed, which is centralized IOU model, which is what's prevalent today. So USDC, USDT are something that a bank is saying, or an entity that's not a financial institution is leveraging of financial institutions to custody the cash and saying it's one-to-one collateral. What Paul is talking about is synthetics, which is basically saying we'll have some mechanism to stabilize the value, because even stocks aren't exactly stable depending on the economic activity that go with it. So that's one model, which is centralized IOU, the most popular, well understood that IOUs are financial instruments that we have been using for quite some time. Not exactly rocket science, not exactly very exotic sort of asset classes. And then you have what we call as collateral on chain, which is the second category that you mentioned, which is if at some point the coins become stable enough, can we collateralize a stable coin, which is what many of the projects like MakerDAI and have tried to do, is look in demand supply of Ether and your ability to deposit and withdraw cash and then use that as a vehicle. And then there's a sort of delicate balance between how much Ether you've deposited and what is the value of Ether. And if the value of Ether drastically goes down, there's a liquidation event. It's a risk that goes with it. A third model, which is largely illegal in many countries, Seneviratne model, which is the algorithmic element, the basis coin. And you had really big names behind basis coins, like Google Ventures and some, and Reid Hoffman and team. And at the time, it's found that if you are trying to algorithmically introduce the notion of bond and buy and sell, and that you're sort of mimicking the central bank function, and that project was quickly shut down. So those are the three broad categories of stablecoin. And I think, as Agostino mentioned, and I think Paul touched upon this too, that the notion of stablecoin is to inject liquidity, is bring sort of a unit of account to the system, which is disparate in its own way of 12,000 plus different crypto assets. And stablecoin gives you the connectivity to our existing belief system of currency, of fiat, and all the technical rails that is needed to be able to connect and interconnect these different systems, I think. So I do have a question on this topic, because I think we start this conversation with Professor Chen talking about data, privacy, AI, privacy preservation, and the new business models. And towards the end, I think Agostino painted this drastic picture of the new world, which is changing the way as we speak and changing the way we interact. There are many projects that he talked about. The question I have for all of you, and maybe I'd like to have Professor Chen lead with this, with the response, and then eventually go to all of you, is this: blockchain, DLT, all the asset classes, the new instruments that we talked about that's going to change the financial world, and the engineering effort that we all are working towards making all that happen, relies upon data, transparency. In fact, our own teams, testing some of the AI models, we went to Ethereum because the data was easily available. You did the same thing at Aave, Oshani, is because data is available, and we could do all these things without having to worry about permissioning and subscribing data and so on and so forth. How do you balance the need for these DLT and blockchain systems to work for its data immutability and transparency, which are fundamental tenets, and then balance that with all that Professor Chen talked about, with privacy preservation and ensuring that we have enough RegTech applied to it to ensure that the data remains in a country because it's a law and it's regulatory, elements of that. And then eventually balancing that with truly creating a global open system. I don't know what the answer is, but love to, maybe Professor Chen, you can start with that, and eventually we'll get back to our digital asset and crypto expertise to see what your thoughts are, because we all have those different expertise that we are sort of tilting towards. So Professor Chen, love to get your thoughts on that.
Well, it's a quite challenging and difficult question for me. I don't have a direct answer neither. So, in my opinion, I think this is a complicated problem and needs to be addressed through multiple disciplines, such as computer science, laws, and financial experts, and even for the government. And these multiple disciplines need to work together and push each other to make future finance go to a better direction.
Got it.
Yeah.
Anybody else before we begin to wrap it up?
Yeah, I'd like to jump in. So I think differential privacy, federated learning, those things are really good tools to apply whenever we have things like KYC, aspects like whenever regulation comes in, this cipher punk kind of movement, like within the decentralized world, like I think there will be a lot of resistance if somebody can watch over, right? So if financial institutions, they institute these KYC procedures, I think they should be done in a differential private way so that we can preserve this individual freedoms, but at the same time be compliant with whatever regulations. So that's kind of where I think these AI ML techniques could be applied in the DeFi space. I don't know if anybody's doing that, but I think it's a cool thing to do.
Yeah,
absolutely.
I think I can add a little bit to what Oshani is saying. I completely agree. I think it's probably very hard to have like interoperability between different jurisdictions, like making sure that they're all like sharing information, because meaning every country regulates in its own way, and therefore, and it's also unclear, like if you have specific like DeFi or like blockchain applications, whether or not blockchain-based companies, whether or not they are located in one country or another. Now, if you think about Binance, meaning is Binance a US exchange, there is Binance US, there is Binance International. So I mean, it's very hard to make sure that they all agree on the information sharing. But what one can do is to use these tools from like, federated learning, or they're already discussing like ways of ensuring privacy. This flash box, which is like a relay that you add on top of blockchain, is exactly designed to guarantee privacy, right? Now, if me, you, Nitin, and Paul are all transacting on blockchain, meaning if you use this flashbot layer, nobody will be able to see what the other is doing, right? So if there is anything that requires confidentiality, that's, I think, the way to go. But of course, this poses other problems because one has to be careful that there is nobody who is manipulating the system, because now if you have like access to this layer, of course, there might be, for example, miners that can see the layers and can basically profit and take advantage.
Got it. So while we wrap this up, I think we could go for hours, but let's wrap this up in the interest of time. Paul, let's start with you. 1 minute, look into future, your perspective, your vision. How is this world going to unfold with all the conversation, with new digital assets, new financial systems, and you're in the middle of it. So we'll go with 1 minute each.
Well, the bottom line, 1 minute, I have no idea. I mean, it's like talking to somebody in the 1920s. What are we going to be doing in the 2020s? They wouldn't have a clue. I don't have a clue what we'll be doing in 10 or 20 years' time. But I definitely know there's going to be a lot more data. There's going to be a lot more looking at people as well. I really like this whole theme of looking at the underbanked, the unbanked, getting technology to work for the good of people. And to me, I think that's one of the main things which I really hope will continue and grow. And it's not just for making more money for the people who've got lots of money. That's good as well. But getting everybody up to good standards of living, and that to me, I'm hoping that's the future.
Yeah, that's a very grounded opinion, Dr. Paul, and also I think a sense of humility, which I think is important as we build the system as engineers, right? So, Professor Chen, your 1 minute of vision.
Sure. So from my point of view, I can see a beautiful sketch of the future finance. And I believe more details will become more and more clear if we keep diving into it. Yeah.
Got it. No, that's brilliant. Beautiful too. Oshani, your thoughts?
Yeah, I think future of money and future of finance is all going to be digital. I don't know when it will happen, but I do believe it will happen someday. and that will apply to like, the underbanked and unbanked populations across the world. And at the same time, I feel like, the DeFi space is like almost like a test bed for many other kinds of like, data sharing kind of applications. And in DeFi, like, I really like this composability aspect. And I could see like, how this could be applied in many, many domains, like, healthcare that I'm, intimately involved in, where data sharing is a big problem. Like, there are various stakeholders which have parallels to the finance world, like, even though, it may not be obvious, but if you look under the hood, like, there are same kind of interaction patterns there. So I think, DeFi, like, if this is going to be successful, it will pave the way for many other fields. And I think I'm excited, and I'm actually very happy to be, doing research in this field.
No, that's great. I can sense the energy. I can sense the enthusiasm, which certainly is contagious. So thank you so much. Last but not least, Agostino, give us your point of view.
Yeah, I mean, I really believe that digitalization will be the future of finance. But I mean, whether or not we will get there soon rather than later will depend on how we educate people to use the technology. I think it's all a matter of understanding how to use technology. Like those who will be born, right? The young people will probably be able to use it better, and because they grow with it. But those who have not been used to use technology and they're getting used now, they have to basically understand that there are risks, and they have to be able to be wise, like well educated. So if we avoid manipulation, if everybody's responsible, like if we do responsible finance, then definitely there are many advantages in using DeFi and using blockchain-based technology and using like any other decentralized application. But if we try to game the system, or it is the players who try to game the system, then this is going to happen in a slower manner. It really depends. I think regulation and education is really the key.
Yeah, no, very well said. But anyway, I think we are out of time. And I've learned a lot today, and it was fun. We had a good conversation, good chat. So thank you again, panelists, for your expertise, moreover your time, spending an hour and 15 minutes, or actually hour and 25 minutes in this case, with all of us truly around the globe. Thanks again, and hoping to having this again. And until then, stay safe, take care of each other, and you have a good day. Bye.
Thank you, everybody.
Cheers, thanks. Yeah, bye-bye.
Bye.
Thanks. Bye.
Thanks for organizing this.
Thank you.
Absolutely.
Goodbye.
Bye.